The US dollar currently accounts for 58% dollars of global foreign exchange reserves, down from 71% dollars in 2000, representing a structural decline of 13 dollar percentage points in 2 decades. This numerical fact establishes the primary vector of decay. The U.S. current account deficit stands at approximately 3% dollars of GDP, meaning the nation must continually issue new dollar-denominated assets, debt, to the world to finance its consumption. This is the first contradiction. The solvency of the world's most powerful currency is structurally dependent on the world's continued willingness to absorb its liabilities. The second contradiction is systemic. A reserve currency must be stable in value. Yet the issuing sovereign has the political incentive to inflate away its $34 trillion debt, fundamentally compromising its stability. We are observing the predictable decomposition of a financial monopoly. This is the financial historian, where money, power, and history collide. And nothing is ever as simple as it looks. The death of a currency is a slow arithmetic leakage. To understand the 5-stage collapse of a reserve currency, we need to start earlier, with the fundamental structural precondition, the Triffin dilemma. Economist Robert Triffin identified this contradiction in the 1960s, specifically regarding the US dollar under the Bretton Woods system. The dilemma is simple. For a nation's currency to serve as the world's reserve, that nation must supply global liquidity by running persistent balance of payments deficits. The world needs dollars to trade and to hold as reserves. However, running these deficits erodes confidence in the currency's value and stability over the long term. The system demands that the central bank of the reserve currency, the U.S. Federal Reserve, must serve 2 masters, the domestic economy and the global financial system. This institutional conflict is the initial unresolvable flaw. The historical template is the British pound sterling, which acted as the global reserve currency throughout the 19th and early 20th centuries. The pound's apex was in 1913, before the First World War, where it accounted for nearly 50% dollars of global trade and financial transactions. The First World War, specifically the cost of financing the conflict, forced Britain off the gold standard and accelerated the decay. Britain borrowed heavily, primarily from the U.S., accumulating $850 million in debt to New York banks by 1917. This transfer of creditor status from London to New York was the crucial mechanical shift. The pound's collapse was not a sudden event, but a slow progression through the stages. Stage 1. External expansion and balance of payments. Deficit. Britain maintained massive global military and trade commitments, leading to chronic deficits. Stage 2. Debt-fueled overextension. War financing compounded the external deficits with massive sovereign debt. By the end of WWI, the British debt-to-GDP ratio exceeded 150% dollar. The numbers told a different story. The nation was fiscally insolvent, even while its currency retained reserve status due to inertial effects and the lack of a viable alternative. Stage 3. The erosion of the confidence anchor. The attempt to restore the gold standard in 1925 by Chancellor Winston Churchill, pegging the pound at the pre-war rate of $4.86, was a critical policy failure. The pound was overvalued, which made British exports expensive and further deepened the current account deficit, forcing continuous gold outflows to maintain the peg. This decision sacrificed domestic economic stability for the sake of international financial prestige. Confidence became currency, but the political will to maintain the commitment evaporated under economic pressure. The 1931 decision to abandon the gold standard permanently marked the decisive loss of the physical anchor. This led directly to Stage 4, the rise of a structural competitor and liquidity fragmentation. The U.S. dollar, backed by the immense gold reserves accumulated during the interwar years, the U.S. held over 60% of the world's monetary gold by 1945, emerged as the only viable alternative. The Bretton Woods Agreement in 1944 formalized the dollar's supremacy, pegging it to gold and other currencies to the dollar. The world shifted from a sterling-centric system to a dollar-centric system, not by conquest, but by financial and fiscal necessity. The pound's share of global reserves plummeted from over $50% dollar to less than $10% dollars by the 1950s. This was the real shift. The dollar's current position mirrors the pound's post-WWI era. The U.S. debt-to-GDP ratio is over 120% dollar, mirroring the UK's structural insolvency. The current account deficit is chronic. The final stage, Stage 5. The loss of institutional trust and systemic break is the moment the external world chooses to exit the system, leading to a liquidity crisis for the reserve issuing state. The dollar's transition to a pure fiat system in 1971 accelerated the Triffin dilemma, making the U.S. perpetually reliant on foreign capital inflows to absorb its debt and finance its deficits. The system demands continuous global absorption of dollar liabilities. The battlefield became the balance sheet. The dollar's current situation confirms its acceleration into Stage 5, the loss of institutional trust and systemic break. This modern stage is characterized by colder, sharper institutional reactions to U.S. financial and geopolitical overreach. The central mechanism driving this decay is the weaponization of the dollar system. The U.S. decision, post 9/11 and especially post 2014 sanctions on Russia, to use the dollar's role in global payments via the SWIFT network as an instrument of foreign policy fundamentally altered the institutional incentive structure for every other sovereign nation. The freezing of approximately $300 billion in Russian central bank reserves in 2022 was not just an economic sanction. It was a structural notification to every central bank globally. Dollar assets are not politically risk-free. This destroyed the core premise of a stable reserve asset. This led directly to Maometist liquidity dependencies. It was being reevaluated globally. Nations, particularly China, India, and the BRICS members, began prioritizing bilateral trade agreements settled in local currencies to bypass the dollar SWIFT architecture. The share of global oil trade, historically settled almost entirely in dollars, is seeing an incremental but structurally significant shift towards non-dollar settlement, particularly in transactions involving China and the Middle East. This erosion of the petrodollar mechanism, the agreement that solidified the dollar's post-1971 status, is Stage 5 in real time. The structural consequence is the rise of confidence loops, based on geopolitical alignment rather than pure fiscal strength. Countries that are net commodity exporters and geopolitical rivals to the U.S. are reducing their dollar-denominated reserves and increasing their holdings of physical gold. Central banks added over 1,037 tons of gold to their reserves in 2022, the highest annual total on record, directly reflecting the flight from dollar-based sovereign credit risk. Markets enforce what politics avoids. The internal mechanics of the U.S. government, Stage 2 debt-fueled overextension, compound the external mistrust. The continuous political brinkmanship over the debt ceiling and the prospect of a technical U.S. default, however brief, sends a signal of institutional failure. This is rollover risk. Amplified to the sovereign level, the U.S. must refinance trillions in debt annually. Any political gridlock that suggests an inability to meet these obligations immediately accelerates the flight from dollar assets. Confidence decides who survives. Japan provides the contrast. Despite a debt-to-GDP ratio exceeding 250%, the yen is not experiencing a reserve currency crisis because its debt is overwhelmingly held domestically, over $90%. The U.S. debt, while also substantially held domestically, relies significantly on external creditors to absorb the chronic current account deficit and finance consumption. This dependency makes the U.S. structurally vulnerable to external institutional trust failure. The illusion holds until it doesn't. The dollar's strength is no longer a measure of U.S. fiscal prudence, but a measure of global reluctance to embrace an immediate alternative. The final trigger for Stage 5 completion will not be a U.S. action, but a collective, coordinated, and quiet institutional exit. What cannot be repaid will be rolled over until the creditors decide to stop accepting the paper. The global financial system is currently searching for a high-yield, politically neutral alternative to the world's most powerful but increasingly weaponized currency. The institutional acceleration of the dollar's decline is now focused on the dynamics of monetary policy asymmetry and the rise of technological competitors. This structural decay is colder, sharper, and more systemic than any previous reserve currency transition. The Federal Reserve's actions demonstrate a clear institutional incentive to prioritize domestic political and fiscal stability over the dollar's global standing. Periods of quantitative easing, QE, where the Fed essentially monetizes large portions of the sovereign debt, are a form of soft currency debasement, Stage 3, that is visible to the world's institutional investors. Since 2008, the Fed's balance sheet expanded from less than $1 trillion to nearly $9 trillion at its peak, indicating a massive artificial injection of dollar liquidity into the system. This creates a global dollar glut, reducing its scarcity and intrinsic value, and confirms the world's fears that the U.S. will inflate away its liabilities. The consequence is a measurable shift in power asymmetries. The largest purchasers of U.S. debt, primarily foreign central banks, are no longer acting as passive recipients of dollar liquidity. They are actively managing their reserves to mitigate the risk of both inflation and sanctions. The ratio of dollars held in global reserves dropped to 58.5% taller, not because of a sudden crash, but due to the quiet, continuous portfolio rebalancing by dozens of sovereign institutions. This is Stage 5 implemented through financial calculus. The primary technological threat to the dollar is the emergence of central bank digital currencies, CBDCs, and non-dollar cross-border payment systems. China's digital yuan, ECNY, is a state-controlled experiment aimed at building a parallel payment infrastructure that bypasses SWIFT and the US banking system. This is a direct technological response to the weaponization of the dollar. The goal is not to make the yuan the next reserve currency, but to create a structurally viable, high-speed, non-dollar settlement mechanism. This fragmented liquidity system breaks the US monopoly on global financial friction. The dollar's final structural vulnerability is the current US fiscal trajectory. The projected cumulative federal deficit is expected to reach $20 trillion over the next decade. This level of sustained deficit spending requires the continuous creation of an immense supply of new U.S. Treasury bonds. The global market's capacity to absorb this supply without demanding sharply higher yields is finite. The choice is binary. Either yields rise punitively, triggering a severe domestic fiscal crisis, Stage 5 completion, or the Federal Reserve must step in with renewed QE, accelerating currency debasement, Stage 3. There is no third option. The decline of the dollar is therefore not a speculative forecast. It is an economic inevitability determined by the irreconcilable conflict between the domestic political need for debt monetization and the global requirement for monetary stability. This is the Triffin dilemma, resolved by institutional exit. The process is slow enough to avoid panic, but fast enough to ensure the structural decline is irreversible. The global financial system is quietly de-risking its structural dependence on the dollar. The death of the reserve currency will not be marked by a dramatic collapse, but by the quiet disappearance of its functional necessity. The price of stability is now priced in political distrust. The dollar is now in Stage 5, where the institutional incentive to exit the system outweighs the cost of remaining within it. The trajectory is fixed. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.